Good afternoon, everybody. I am Serge, Portfolio Manager for COL Investment Management Inc. and moderator for today's session. So just a bit of a recap, during our last investment summit held in November, fixed income markets back then were attracting a lot of attention given the high rates being offered to investors. Stocks likewise started to rally from their October lows as inflation peaked and the US showed signs of US inflation going down and the Philippines showing signs of following suit. So back then, we advised investors to do two things. First, it's to rebalance away from a conservatively high money market exposure towards more bonds. And then two, to diversify one's equity allocation portion to include more of global equity funds. So looking back, the strategy has actually performed well thus far as bond yields have stayed high. It provided a helped give a good return, and equity markets globally have performed well. At the meantime, if you look at here locally, the PSEI has remained weak and struggled. So at least for today, we again seek to shed light on what might be the wisest course of action for one's overall big picture asset allocation. So to help us are three esteemed experts, and with them, we will have three individual segments each, culminating with a Q&A. So first on our list, and here to discuss about the current state of global markets is Director and Product Strategist for BlackRock Asset Management, Mr. Zach Bevevino. As many of you may know, BlackRock is renowned as the world's largest asset manager, with a staggering $9 trillion plus in assets under management. So Mr. Bevevino is a member of BlackRock's multi-asset strategy team and is responsible for constructing active asset allocation strategies, portfolio solutions, product management, and the servicing of retail institutional client relationships. So without further ado, broadcasting from Singapore, ladies and gentlemen, let us welcome Mr. Zach Bevevino.
That's great. Thank you for the kind introduction and appreciate the invite for BlackRock to join today's session. Super excited to be here to share some of our views on what's going on in markets. Clearly, as was mentioned in the beginning, a lot of uncertainty today, but I think one of the positive things, and hopefully this will come across in today's presentation, is we've seen some massive changes in the last 18 months that have really come to kind of reshape the investing landscape. And in some ways, it's a more exciting time today than we've seen in a very long time, especially if you're trying to build globally diversified income portfolios, because we ultimately just have a lot more to choose from today than we recently did for much of the past decade. And so I like to see the poll in the beginning, which talks about getting regular income investments. I think that's very core to what we'll talk about today, and obviously a lot's changed there. So we'll try to unpack that a bit more. I'm going to focus my comments more on the global markets. I'll let some of my colleagues talk a little bit more about the local markets. But to dive into this, let me begin by just sharing our view on the macro backdrop and kind of what are the driving forces in the macro landscape today that have come to shape the global markets. And so if we could jump to the first page here, I'd start by maybe just emphasizing the idea that I think what you saw happen in 2022 when markets were incredibly challenged, and you can see this on this page here where we're showing you global stocks and global bond annual returns, and you have to go all the way to the left quadrant, bottom left quadrant, to see 2022 bond returns and stock returns, which were both kind of deeply in negative territory, a very, very unusual occurrence. It's not common to see your safe haven assets and your kind of risky assets like stocks both be down in the same years. But when you think about what happened last year, which was really skyrocketed inflation and central banks reacting to that by tightening policies, it actually makes sense that both of these kind of markets were down. Encouragingly, and this was one of our messages as we started the year and ended 2022, was actually we felt like a lot of the pain that was had in 2022 was going to set up for at least a more positive return environment in 2023. And I think there's still legs to that. We still think there's interesting opportunities that can be had in markets. We don't think now is the time to take on extended levels of risk. At the same point, I think a lot of investors have been stuck in cash and at that point, leaving some money on the table because there are some interesting opportunities, which we'll highlight today. But ultimately, the themes that were shaping markets last year are still very much in focus. And I would characterize those in three main driving forces, which is inflation, central banks' reactions to that inflation, and ultimately the result of all that tightening and what it's going to do to growth and fears of a potential recession. And so just to highlight some of our views as it relates to these very interrelated kind of macro themes, let me start with the inflation point. If I could jump to the next page here. On the inflation side of things, inflation, which you could see on the left-hand side of the page, is still in most major markets outside of China running at high levels. But encouragingly, we've actually seen it start to moderate. And we think it will continue to come down. It will take time to get back down to the levels that we saw pre-COVID. And it may happen over a very extended period of time. And so we think there's still work to be done to actually get inflation down, but the trajectory of that inflation has clearly cut lower, and you could see that on the left-hand side of the page. Most recently, if we look at the US CPI print or the Consumer Price Index, you saw it come in at about 5% year over year in the most recent reading, and the headline inflation, which includes things like energy and food prices, came in at 4%. These are related to or compared to numbers that were closer to 8 or 9% about a year ago. And so inflation has come down quite a bit from where we were 12 months ago, but central bank targets are closer to 2%. So we're still running at levels that are about 2 times the amount of inflation that central banks like to run when it comes to inflation. So that means that has implications for what central banks are going to do from here. And I'll touch on that just in one moment here. The thing that we think investors should pay attention to is on the right-hand side of the page, there's been a divergence in the kind of the inflation trends. And when you unpack this, it really makes sense when we think about what individuals have done over the course of the last couple of years since COVID, where a lot of people, what they did during COVID was buy a bunch of goods because the services part of economies were shut down. You couldn't go out to go see a movie, you couldn't go out to eat. And so services inflation was quite low. And goods inflation went really high and skyrocketed because people were buying things. And for the most part, consumers actually globally were in actually pretty healthy shape because of some of the stimulus measures that a lot of governments took. You're actually starting to see that now reverse. And so services are now starting to see inflation come back because people are getting back to a more normal life, and goods inflation is starting to roll over. We think investors need to pay attention to this because services inflation tends to be stickier, meaning it lasts longer, and it has a high correlation or related to wage growth. So when people are getting paid more, they want to spend more on services, and that makes service inflation a bit stickier. And so we say pay attention to this because this actually could mean that inflation will take longer to come down to those normal levels than most probably were anticipating at the start of the year. And so when we think about, okay, we have an inflation environment where the trajectory is lower, but we're probably not going to get to a level that we saw pre-COVID anytime soon. So what does that actually mean for central banks? And so if I jump to the next page here, what we've seen in reaction to this, and I'll highlight the US Federal Reserve, the central bank in the US, because they are the largest central bank and have ultimately the biggest impact on markets globally. But it's not just the US. You've seen tightening happen across much of the developed world over the course of the last 18 months or so. On the left-hand side of the page, we show you this tightening compared to other tightening cycles. And what you can see is, the punchline is it's the fastest that we've seen since the early 1980s when we previously had a very significant inflation problem. And so the Fed went from a 0% policy rate at the start of 2022 to over 5% today. That is a significant amount of tightening over a very, very quick time period. And so the concern now is that amount of tightening, when you put that onto an economy, is going to have implications for growth. And that's why I think investors are really fearful of a recession here. And on the right-hand side of the page, you can see manufacturing, which tends to be the most sensitive to tightening cycles, has really started to roll over in the US and Eurozone, where you've also seen inflation and central bank tightening. And this will have an impact on growth. And we do think you're starting to see evidence of growth slowing down, and the risk of a recession is no doubt higher than a normal year. And that keeps us measured in how much risk we want to take right now, because we are in a world, when you look at it in aggregate, inflation is still pretty high, central banks are still tightening, and growth is slowing. So there's a lot of uncertainty around those things. And so that leaves us a bit patient around how much risk we're wanting to take today. But I counter that with the idea that we're still not in the camp that we're heading into a severe recession. I still think there's, particularly in the US, I think there's a lot of positive signs. Probably most noteworthy that the labor market is still pretty sound. You're seeing wage growth. Unemployment is at the lowest level it's been in decades. That's not really consistent with a severe recession. Typically, you see a soft job market, but that's not been the case yet. And so that can soften. We think that can, but ultimately, consumers are in pretty healthy shape, and that's the bulk of the U.S. economy, is a consumption-based economy. And so even if you see a technical recession, we're not in the camp that it's going to be severe like the one we saw in COVID or the global financial crisis in 2008. So this is kind of tread carefully, but at the end of the day, we don't feel like we're going into a period we're going to see a severe recession, but you have to at least recognize that growth is slowing, inflation is still high, and central banks are ultimately tightening. And for one last comment on just the central bank picture, is just our view on what we think the Fed and other developed central banks are likely to do, barring a significant slowdown in growth, which is different than what we've seen in the past, is they're likely to get to a point where they're going to keep rates in restrictive territory, because they ultimately are fighting the inflation battle still. So they're going to keep inflation at rates at a restrictive level and likely keep them there. And this is different from what we've seen in previous cycles, because typically what you've seen is central banks react to kind of hot economies, they hike interest rates, and as you start to see those things moderate and growth start to slow, they react again by cutting interest rates. This time may be different, where they don't react the same way because of this inflation dynamic. And so that means the Fed and other central banks may not come to the rescue as they have really since the post-2008 era. Anytime you've seen kind of scary markets or a scary growth backdrop, you've seen stimulus. We don't necessarily think that's the case this time around. So you do have to be careful that the Federal Reserve and other central banks don't necessarily have your back. And so that leaves us in a position where there's still a lot of uncertainty. I think you have to recognize that. At the same time, there's still interesting things that have happened over the course of the last 18 months that lead us to be in a very different world. I would say most notably with what we've seen happen in the bond side of portfolios, where there is income available now in global fixed income. That's a very different dynamic than what we've been dealing with in the last 10 or so years. And on the equity side, as we'll go through, yes, equities are higher this year, but a lot of that's been driven by a handful of names. It's not been very broad-based. So actually, we think there's some interesting things happening even in stock markets right now that investors should be taking advantage of. So let's maybe dive into those. If I jump into the next page here, and actually before going into that, this is I think a timely chart, because we work with investors globally. And I think one of the themes that we've seen is that a lot of individual investors, unsurprisingly, after a very challenging year like 2022 and the availability of higher yields in cash, have gone to cash in a pretty significant way, or bank deposits in a pretty significant way. And we've argued that that's not the time to do it, because typically when you see challenged market environments, the future return periods actually tend to be pretty favorable. And you can see that already playing out on a year-to-date basis on the left-hand side of the page, where cash or money market funds have generally underperformed global markets. But maybe more importantly, if we look on the right-hand side of the page, if you look at the 12-month returns following the last Fed rate hike, it's generally pretty positive across asset classes in the fixed income and the equity world. And cash gives you a positive return, but it's not that much. And so I think for investors that are still owning a lot in cash, there's opportunities today. That doesn't mean you put all of your cash to work, but I think if you have over allocated to something that's incredibly low yielding, there's opportunities for you to lock in higher quality income for a longer time period. And that's really what we've been trying to do in our global portfolios. So where are those specific opportunities? If you jump to the next slide, if we look at this, this is just a holistic view of global fixed income markets. And ultimately what we're showing, to kind of hit the point that I was mentioning previously, it shows you global fixed income markets or global bond markets that give you a yield over 4%. And the way to read this is if I go back to 2000, virtually everything in global bond markets were giving you a yield over 4%. The size of the bars represented the size of those markets. If you fast forward to 2008, most of those markets went away. They no longer provide you any yield, and that's where we stayed for the better part of the next decade plus. And now within the last year and a half, you've started to see that return. You started to see markets actually provide you yield again because of what central banks have been doing. We don't think we're going to go back to a zero interest rate world. That's ultimately a good thing for the savers of the world. So this is a positive thing. The adjustment to get here has been painful, but we ultimately think this is a positive thing. So let's go into, for the benefit of time, I may skip the next page. We go one more and just talk about some of the areas that we actually have been favoring. We have been adding to, in our global strategies, areas that we deem high quality, low interest rate risk, because these are areas that have adjusted a lot from a yield standpoint, and we don't view them as very risky investments. So when I think about the investors that are heavily in cash, they don't have to step too far out on the risk spectrum to lock in yields for a longer time period. And so an example of this is if you look at US investment grade bonds, think of these as high quality corporate bonds in shorter tenors, so 1 to 3 years. They went from yielding close to 0% to yielding over 5%. And you could see over the last decade or so, the average yield there was about 2%, and now we're at 5.5%. This is a high quality bond, 5.5%. You don't have to take on a lot of interest rate risks. So meaning you don't have to buy a bond that matures in 30 years. You could buy a bond that matures in 3 years and give yourself 5.5%. That looks really attractive to us. Similarly, there's a market in the US that's a floating rate market. So these are corporate bonds that actually have a coupon that will go up with interest rates as interest rates go up. The benefit of that is you don't take on interest rate risk. That's a market that's also high quality in terms of its credit quality. But it's yielding closer to 6% today versus an average of about 2.5% over the last decade. So two areas that we deem high quality, low interest rate risk, and giving you healthy levels of income. For a lot of our global strategies, this is exactly what we're trying to focus on for our portfolios because we think there's good income here. We also think if you're building a global portfolio, these areas can act as a diversifier to what is ultimately still a pretty uncertain world. If you jump to the next page, one quick comment on stepping one step out on the risk spectrum from those higher quality markets, which is looking at high yield corporate bonds. So these are typically smaller companies. They tend to be a bit riskier. They tend to have a bit more leverage. But as a result of that, they tend to have higher yields that are available to investors. And so high yield bonds right now in the US yield over 8%. And we actually think that that's a pretty attractive level and prices in a lot of risks that could happen from here. So a lot of bad things would have to happen for you to be negative in those when you're thinking that you're going to earn 8% as a starting point. And if you look at the bottom right, I would just highlight this quickly, that if you look at your starting point yield, and this is what this graphic shows you, your starting point yield, and then what your return is in the 12 months following that. So if you bought a bond at 8%, what was your 12-month return following that? And here we show you where that breaks out over the last 20 years on average. And if you look at the top row here, you can see if your starting point yield is 8% or above, generally speaking, the returns have been really positive and strongly positive in most instances where the average return is over 14%. Now, there's been the one period, which is 2008, where you had a negative return when yields were still pretty high. But again, we're not in the camp that we're heading into a severe recession. So we don't necessarily think that that's a high likelihood. We do think you need to be selective in these markets because we are still in a slowing growth world. So you don't necessarily want to own the lowest quality bonds, but there's still opportunities within this market to be able to generate some good income and not have to worry so much about the recession risk. So if I jump ahead here in the last couple minutes, just talking a bit about what I think investors also should pay attention to. If you jump to the next slide, is just on the equity side, because I think, again, with what's happened in 2022, investors no doubt got a bit conservative towards the end of the year and the start of 2023, and now we've seen this big equity rally that I think most investors have generally missed out on because they were too conservative at the start of the year. And that's something that even if you're in bonds and you're not in cash, you're still likely to miss some of the full market rebound that's possible. And that's what we show you here. What we're showing you in black is the upside capture of different bond markets. And so this is how much of your return will you get when equities rally. So the way to read this is if you go all the way on the left and you look at the Bloomberg US Corporate Bond Index, which is US corporate bonds, the 22% on that bar means if equities are up 10%, you're going to be up 2.2% in that asset class. And on the yellow, it's showing you what your downside is. So similarly, if equities are down 10%, you're going to be down 2% in that asset class. And then if you go all the way to the right, we highlight dividend stocks. And dividend stocks is an area that we've continued to like. It can give you some upside capture in markets, also can give you lower downside than broad markets. So it's a way for investors to start incorporating getting some of that market return, that market rebound, but maybe not take on the full market risk. And so we've continued to kind of complement some of those fixed income or bond markets we like with kind of high quality dividend stocks because we think they look attractively valued today. Now, the one interesting dynamic that's I think been well telegraphed now at this stage, if you jump to the next page, is just the dynamic in equities has been very unique this year. And this has been mostly specific to US equities, where US equities are up close to 15%. The S&P 500 is up close to 15%. Most of this is driven by 7 names in the index. So the largest 7 technology names. And so you could see that on this page here, that from the start of the year through the end of May, these trends have continued. Mega cap tech stocks were up 29%. If you look at the S&P 500 through that time, it was only up 6%. And if you look at the other 493 firms, they were up 0%. They were flat. And so a lot of what you've seen happen in equities this year is because of the buzz around AI, and that's led to a massive rally in the mega cap tech indices. That's made us a bit more cautious on overall equities, because when we're investing in equities, we like to see breadth of positive returns, not just it be concentrated in a few names. We're actually starting to see that now, and that's been a bit more encouraging, and we think that can continue if recession risk kind of remains at bay. But up until this point, when you're just looking at an index return, you'd think that the S&P 500 has actually done really well this year, and it has, but most of that has come from just 7 names in the index, whereas the rest of the index actually hasn't rallied all that much. And I think this goes into where we're playing equity markets today, where we've generally been favoring the non-tech space a little bit more now, because the tech areas look a bit more expensive to us, whereas the other areas actually look reasonably valued. And I'll just end maybe just on one example of that. If we go to the next page, just to be conscious of time here, and for the benefit of time, I'm going to skip this, but if we go to the next page, just looking again at dividend stocks to kind of further emphasize this point, we're looking at valuation levels of US stocks, of those stocks that have no dividend yield. So typically these are growth oriented companies because they don't pay out anything to investors or shareholders, because they want to keep the cash and grow their company. Those are trading at very high levels today. So those are the ones that are in the red line here. And really, they're trading at higher levels than we've seen at any point in the last 15 plus years, outside of that COVID time period when we really saw technology rally. So we would kind of say they look pretty expensive to us today. So the bar for further gains right now looks higher. But if we then go to the names in the index that are actually providing you the highest dividend yield, those are trading at cheap values relative to the higher growth names and relative to its own history. And so when we think about dividend stocks, they tend to also have, a quality element to them. So you could buy companies that have good dividends, good dividend growth, high profitability, low leverage. All of those things make sense to us, especially in a world that is still fairly uncertain, and you could do so at reasonable valuations. So when we think about kind of the global portfolio context, it's high quality fixed income that we've been adding to, and also complementing that with some of these quality dividend stocks in a world that's still pretty uncertain. That actually makes a lot of sense to us because there's good income to be had, and you don't necessarily need to stretch from a risk perspective to ultimately get there. I just want to be conscious for the rest of the speakers here, so I'm going to leave it there and then happily take any questions from the audience and just say thanks again for the time and attention and inviting us to join today's session.
All right. Yep. Yes. Hi. Yeah. Thank you, Zach, for that excellent presentation. So I'm also just trying to catch up as well to all of the concepts that you discussed. But yeah, thank you so much for making it ultra detailed. And at least just for me also as a Philippine investor, this is not, this type of information is not something that we also get to come across quite frequently. So we appreciate you sharing your insight. Thank you very much for that. The main takeaway from me, I guess, actually from your presentation, is it was very interesting to know that both stocks and bonds have actually performed well after the last rate hike. So assuming that maybe the Fed's pause stays paused, or maybe if we see a maximum of just 2 more rate hikes for the year, perhaps that could provide some clearance for additional performance in the medium term or on the long term. Would you think that's possible?
Yeah, I think that's right. You know, I think the history kind of guides us to the idea that once you get to the end of a hiking cycle, it's the restarting of things, and then that tends to lead itself to more positive returns across markets. The difference this time around is still the Fed is dealing with this inflation problem. And so when I think about the Fed, there's probably two phrases I would use to describe how we think what they're going to do in terms of their policy, and that's higher for longer, pause, not pivot.
Yeah.
And what we mean by that is they're likely to pause, but they're not likely right now to start cutting interest rates again, which in previous episodes we would have said they're probably, you know, they're going to do that because that's typically been their reaction to slowing growth. But because of the inflation dynamic, we think they're going to stay in restrictive policy. So you do have to be mindful of the idea that if they pause here, you still could see economic growth slow. It's not entirely in the clear on a rally here. What gives us some calm though is that when we look across markets today, again, there's things you could buy that actually look attractively valued. And so they kind of price in some of those dynamics. Like you remove all those tech stocks and actually stocks look pretty reasonably priced. At the index level, it doesn't because they're getting distorted by all these technology names. But you start to remove some of those, then that actually looks pretty interesting. And you could kind of pair that with a 5% coupon in what was stuff that yielded 0% not that long ago. Like that actually looks like a pretty good portfolio.
I see. Okay. All right. Okay. So I guess maybe just to help move things along and at least to also make the presentation a bit more relevant as well for Filipinos in the local setting. It was mentioned that you're in charge of providing asset allocation strategies to your clients. So I guess at this point, in your opinion, what are the best global investment themes and trends that local investors in the Philippines can actually participate in at the moment?
Yeah, for me, I would say the biggest change has happened on the fixed income side globally in the last 18 months. So I think if you're an investor locally, you could start to take advantage of some of these higher rates that you're seeing in global bond markets. And that's being felt in developed bond markets. It's being felt in higher quality corporate bond markets. You don't necessarily need to stretch like you once did in the last 10 years to actually get a reasonable income. So I think that's kind of number one, because that's been the biggest change in the last, really since the start of 2022. And then the separate point is, and you saw this in the polling, is that I think unsurprisingly you see this in most markets. There's a home bias to investing in your local equity market, and no matter what market you go in, that tends to be the case because people are familiar with the companies. They like investing in companies that they're familiar with, and I would say I think there's some benefit to having global diversification, and the S&P 500 is a really good example of a market that's generally a pretty resilient market in terms of its profitability, its earnings. You're seeing that again this year, even though it's been driven by the highest cap names. Just buying the S&P 500 has actually been a very resilient trade. I think the other thing that investors often overlook is that the US equity market, 60% of the revenues come from the US, 40% of the revenues come from overseas. It is a global market, even if it is US in name. And so you're buying the highest quality multinational companies globally when you invest in US names. And so we still kind of lean into that. I think wherever you sit, I think there's a benefit of having that in portfolios today. Where we have more specifically been going is some of these more dividend growers, because I think the point I would make is if you look at technology stocks, they trade at a level of about 32 times forward earnings. Dividend growth stocks trade at half that amount today. And so these are also quality companies. So, and that means the bar for further gains is lower when you're buying these quality companies versus the technology names where there's clearly a lot of buzz and they could continue to go higher, but the bar for that is now higher as well.
I see. All right. Yeah, thank you for that, Zach. So I guess maybe at this point we could also field in some questions. All right. So yeah, the way we structured our Q&A for this afternoon is we group them according to similar type questions, and we just have the representative type questions on the right, at least in terms of the topic group. So first one, our listeners are pretty much interested on like this recession narrative. So I guess for BlackRock, do you guys think that the global recession will become reality this year? And I guess you also already mentioned that recession risk is there, but you guys are not seeing a hard landing. So maybe at least just to help clarify things, do you guys have a timing element as to your expectations with regards to recession?
Yeah, I think this is one of the key questions for investors this year, and maybe actually more so next year is how is the growth going to play out in much of the world. And so it's likely to be different depending on where you're actually looking. So if you're looking at the emerging markets, you might actually see growth be pretty strong this year, particularly in the Asia Pacific region, where you're going to see a lot of global growth be driven from regions out here this year versus the developed world, where the US and Europe, there is a chance that both of those markets will end up being in a technical recession. The Eurozone is likely already there in terms of being in a technical recession. And the US, the risk of that today, again, is higher than a normal year, given the tightening that we've seen in markets. But I think investors need to be aware of the severity of the recession and the longevity of the recession. So I would go back to 2008 as an example of one that was very severe and very long. And I would go to the 2020, which was very severe and very short. Where do we fall this time around? I would say you could find yourselves where you get negative economic growth, but we don't think it's going to be very severe or very long, is ultimately kind of how we're thinking about it. And it may be pushed out into not 2023, but start to think about it more in 2024. When some of this tightening that you see continues to play through the economy. I think for the point I always make on this is that it's also important for investors to think about, okay, what is growth going to look like, and how are markets going to behave to that? Because clearly there's a disconnect sometimes between these things. I mean, look at the US. The US has had slowing growth, but its equity markets are up 15%. China has had very exceptional growth to start the year, and its equity markets are down negative. So for investors, it's not just about whether economic growth is going to be strong or weaker. It is a bit more complicated than that. You have to understand kind of the dynamics of what's happening beyond that. And that is to the point, there can be a disconnect between slower economic growth and what stocks are doing because of other trends that are at play, like technology. And so it's not just as simple as saying economic growth is going to slow, stocks are going to fall, you don't want to own stocks. It is a bit more complicated than that. I'd also say timing the entry and exit on these things is very difficult. And so for us, typically when we're thinking about equity investments, they're investments. We're not trading these. We're thinking about multiple years of investing in companies that ultimately we think are going to be well suited for the environment. And that's goes back to this whole quality element of buying companies that can kind of weather the storm a bit. So yes, I think the risk of a recession is higher this year. You could very much see the US head into a technical recession. Eurozone's probably already there. But the severity of that, we still don't think is like we've seen in previous episodes, like during COVID or the global financial crisis, largely because I think the underlying consumer strength is still there. And that's a very important dynamic for consumption-based economies. Until that really changes, I think we still feel relatively comfortable about still taking on some equity risk today because of that.
All right, great. That's very encouraging to hear. So at least we could still continue investing in these income-paying options and equities. So this time we have questions on the importance of global markets. So this question from Willie: is it true that Vietnam, Thailand, and Cambodia are much bigger markets than the Philippines? So if ever, will foreign buyers go there first when they do start buying emerging market? And maybe just to tie into that also, what are the reasons why global investors still shy away from the Philippine market, despite good corporate earnings and having amongst the fastest GDPs in the region?
Yeah, this is a good question. Maybe better suited for some of the speakers that are going to follow here in terms of the local markets. On EM and the Asia Pacific region, I think we are generally more positive on this, and there's partly due to China rebounding here, but there's also underlying stories. There are kind of supply chain rewiring economies here that are going to benefit from that. You know, Vietnam, Cambodia certainly are on there, or economies are going to benefit from just increased tourism. Thailand and Philippines are also likely on those lists. But in the emerging market world, there is still a lot of volatility in those markets. And so if I look at emerging market stocks broadly, those stocks on any given calendar year, 2/3 of those stocks move by 40% or more.
Okay.
That's a very big move for investors. So I think when a lot of global investors, when they're thinking about where they want to invest, typically emerging markets is sized at a lower weight because they tend to have higher volatility. That's usually why you see smaller allocations to such asset classes, because they tend to have a bit more volatility. But that doesn't mean they should be held in a portfolio. And in fact, when we think about emerging markets today, there's a reason to be a bit more optimistic here, because especially in Asia, because we're at different states in terms of inflation and central bank tightening than we are in the developed world. China has slowed, but still is likely to see pretty good growth this year, which should help kind of the Asia Pacific region. So those are things that lead us to be more positive. But when we think about kind of how we size these things in global portfolios, one, typically these companies are much smaller than what you're going to get in kind of the developed space. And so naturally they should be sized a little bit lower in portfolios. And two, they tend to have a little bit more volatility to them, which leads, generally speaking, to global investors to have a little bit less exposure to such things. And the other point I would make is, I think for a lot of investors that just have been investing in local fixed income, now there's opportunities to do that in developed government bonds, where previously you probably wouldn't even look at those things before because of them being at 0% rates. Now that's quite different. And so I think for a lot of investors, global investors that maybe have allocated to emerging markets on the fixed income side for a number of years, don't necessarily have to do that, because there's other global bond markets that now provide you yields in the 4 to 5% range, if not higher. Whereas for much of the last 10 years, that was not the case.
All right, thank you. Okay, so I guess our last set of advanced questions, if you could flash that, pertains to sector outlook. So maybe just a very short answer here, Zach, so that we could proceed at least maybe with 1 or 2 live questions. So first from Emily, what industry will dominate the second semester of this year? And the next, which type of equities do you think will be more profitable and sustainable in the next 2 years from Melodia?
Yeah, I'll try to answer this quickly. I think the technology, what we're seeing play out in technology could have some legs to it still. I think there's a lot of buzz going on around AI. I mean, you can see this in the earnings calls and CEOs and how much they're quoting this. And there's clearly going to be beneficiaries to this trend. So you can't ignore technology. It has run a lot, but it can continue to go from here. And so I think for investors that have no exposure to that, they should think about that, because these are kind of mega forces that aren't going to play out just over the course of the next 6 months, but are going to play out over the course of many, many years. So having technology in your portfolio 100% makes some sense. In terms of another area that we've generally liked and is a larger weight in our global strategies, healthcare is another interesting area, because it has an appealing combination of pretty good growth potential, reasonable valuations, and it's more defensive. And so if you're worried about kind of the global slowdown, those are characteristics that actually really stand out to us as being appealing. And it trades at a pretty significant discount to other defensive sectors like consumer staples. And so that's an area that we've generally, alongside some of the growthier areas, which we've taken some profits on because they've rallied so much, but we view those as secular. Healthcare is a good defensive area that the demand is going to be there, especially for the next several years, given the aging demographics that we're seeing globally.
Okay. Thanks, Zach. So tech looks like it could sustain a bit more, and then healthcare as a defensive exposure. All right, team, do we have some live questions which we could ask Zach? Okay, so this one is from Mika, and she asks, with U.S. economy and manufacturing slowing, inflation tapering, rates pausing, and some EM markets improving, is it a good time to begin buying while markets are weak? If not today, when should we start?
Yeah, good question. So on kind of the timing of these things, I've generally not been a proponent of trying to say time these things. I think it's more about kind of time in the markets, especially when it comes to equities, because equities should be thought of as at least 3-year investment, not 1-year investments. And again, when we think about our portfolios, we're investors, not traders. There's a big difference between those things. At the same time, I wouldn't go full risk right now, because I still think there's some uncertainty that exists here. But if I was an investor that had a pile of cash that I de-risked from 2022 because I was scared about what was going on in markets, I would absolutely think about putting those into different global markets today, because there's still value to be had if you're willing to take a medium-term view. It doesn't mean markets can't go down over the course of the next 6 months. But when we look at what's happened on 2022 till now, a lot of these markets have just derated. And so again, if you're taking a medium-term view, you could buy these things at cheaper levels than you could a year and a half ago. That's a good thing if you're an investor. And so I wouldn't shy away from kind of doing that. We have typically guided to say, especially in a period of uncertainty, avoid the timing risk of markets. You could do that by just kind of dollar cost averaging into your investments. That's something that we've oftentimes done or advocated for. Or if you're buying an income-oriented investment, it's an easy way to take the income and reinvest it into something else, and you just kind of invest regularly into markets. That's another strategy that we've generally advocated for. But I think it comes down to really individual positions on how much you have in kind of cash and fixed income versus equities. And if you're over allocated to those things, I wouldn't shy away from putting some of that money to work in some of those areas that I mentioned, because I think there's still value there.
Thank you, Zach. And at least for everyone, please stay in tune, because at the end of our session here, we will discuss what is our recommended actual asset allocation for you guys. So if we could just maybe have one more live question in the interest of time. Can we see that? All right. So this is from Samuel G. There is news about BRICS currency. Is it true or not? And what is the effect in, I guess, to the US dollar if that is true?
Yeah, we get this question a lot. I was in 3 different cities in the Philippines about a month ago doing some events, and this was, I would say, a very common question, was just a path forward for the US dollar. And so US dollar saw a lot of strength, and typically the US dollar, its strength is a function of two main things. Strength or weakness is a function of two main things. It is the investor sentiment in markets, whether people are feeling risk on or risk off, and it is the interest rate differential in US markets versus the rest of the world. And so last year, when the Federal Reserve was hiking interest rates and there was higher interest rates there and people were fearful, the US dollar tends to get a bid. That's reversed a little bit this year because people have started to price in the Fed ultimately going on pause and not hiking interest rates forever, which was eventually going to happen. And risk sentiment has improved, so you've started to see the US dollar weaken. But more recently, it's kind of held water now, and it's started to tread. And I think that could continue here. I don't think we're in the camp that you're going to see the US dollar fall through the floor. Now, longer term, more strategically, I think probably the underlying point of this question is there's something else that's going to happen to the US dollar, where the US dollar is going to be kind of unseated as a global reserve currency. And while we think that could move in a certain direction, where maybe there's transactions that happen in a more significant way in other currencies, it's really hard to envision a world anytime soon where the US dollar doesn't continue to make up a significant portion of global reserves and global trade. And so we think that will continue to be the case. Again, maybe that comes down a bit with other currencies starting to come into play, but it's hard to envision a world where that looks terribly different from where we are today.
Okay, so at least for Samuel, it looks like the US dollar is here to stay, at least for the foreseeable future. Yeah, and with that, Zach, maybe just some closing remarks before we move on to our next speaker.
Yeah, well, first off, thank you very much for taking the time and time and attention on these things. I would say a couple things. One, I think during these times, it is hard to invest, but I think there are some discipline that you do now that sets yourself up well for the coming years, which is investing at times when markets are a little bit cheaper is typically a good thing. And what we have seen time and time again is investors oftentimes invest at a time when markets are higher. And so as a matter of investment discipline, I would say fight against the urge to do that. Figure out an amount that you're comfortable investing in and try to go into some of these global markets that actually are cheaper today than where they were a year and a half ago. Doesn't mean you spend all of your cash, take on extended levels of risk, but there are interesting opportunities in global diversified portfolios that I think investors should be taking advantage of today.
Great. Thank you so much, Zach, for that. We appreciate the time you've spent with us, and I guess maybe we'll catch up to you again later.
Yeah.
So
always happy to do it.
All right.
Thank you.
Take care.